Hey everybody, it's Canuck Finance here, and today we're going to talk about how to respond to market volatility. Talks of trade wars, increasing costs, and greater economic uncertainty is creating a lot of nervous investors. The general sentiment in today's market and economy is one of unease, where interest rates are coming down, but the threat of tariffs and trade wars is creating a situation that we haven't experienced in many decades. Even though you might withdraw your funds and run for the hills, that may not be the best plan of action. Let's explore what we can do to mitigate our stress and nerves surrounding the markets. First, we need to ask the question, what is market volatility? It's the rate and extent to which prices move up and down in the market. Generally speaking, price changes are within the standard deviation and can be reasonably predictable, although impossible to pinpoint. In 2025, though, we're seeing price changes that are outside the normal range. When prices move beyond this expected pattern, we call it high market volatility. One way we can view the volatility of the market is to observe the VIX index. It calculates the 30-day expected volatility of the S&P 500 index. Details of the index are beyond this video, but what you simply need to know is that the higher the VIX index, the greater the expected volatility in the S&P 500. We can observe that through looking at the VIX index here on Google Finance. Back in early April, we saw that there was a spike in the VIX index, along during the pandemic in 2020 and the Great Recession in 2008. What causes market volatility? There are several reasons why the market may display volatility. Most recently, in 2025, as previously stated, President Donald Trump threatened many different countries with tariffs, including major trading partners in Mexico, China, and Canada. These tariff threats, along with the retaliatory tariffs by other countries, have created a storm of uncertainty, where many investors are nervous to have their hard-earned cash still in the markets. Many investors can also view this uncertainty as a major buying opportunity, so the prices of different stocks and indexes have fluctuated violently over the last couple of months. Other reasons for volatility include changes to inflation, interest rates, GDP reports, as well as company-specific news, investor sentiment and psychology, and overall global interconnectedness of the markets. While you think you might be able to avoid volatility, it's not entirely possible to do so. As an investor, the first thing you'll have to do is acknowledge that volatility will exist to some degree in your portfolio, regardless of your investment choice. How do we respond to market volatility? It's normal to panic in times of uncertainty, like what we're experiencing now. However, it's not the correct thing to do. It may be natural, but this is one of those times where we need to act differently than what is natural. The first thing to do is to breathe and remain calm. You can't think properly when you're panicking. You can become irrational in your thinking, resulting in making very bad decisions that can cost you majorly later on. Take some time to breathe and calm your mind. You'll be in a much better state to make big decisions. Perhaps even sleeping on things overnight will help bring everything back into order within your mind. The next thing you need to do is remind yourself of your goals. What are your investments initially for? Are they for a down payment? Are they for a retirement? Are they for a vacation or a car? If you're saving for a short-term goal, your funds should already be parked in an investment that isn't easily affected by short-term volatility. Think term deposits and money market funds. If you're saving for a long-term goal, such as retirement, any short-term volatility should not have a major impact in your portfolio. Remember that time in the market trumps timing the market. Next, think about the diversification of your portfolio. If you're invested in a small handful of stocks, it makes sense that your portfolio would fluctuate greatly. I recommend increasing the number and types of holdings to help offset the volatility. Look into different sectors, asset classes, and industries to spread out your risk. Fourth, remind yourself what you can and can't control. You cannot control what the markets will do and can't even control the news. That said, There are things you can control, such as your savings rates and your asset allocation. You can even control what information you receive through educating yourself about investments. Rather than focus and stress on things you cannot control, focus on what you can control. Finally, you can review what's in your portfolio and strategically rebalance it. Depending on your risk tolerance and time horizon, you may want to shoot for a particular mix of asset classes. For a balanced investor who is planning on taking out these funds in a few decades, a split of 60% equities and 40% fixed income is fairly typical. For those that are more aggressive in nature, a higher split up to 100% equities would be recommended. For more risk-averse investors, or investors looking for shorter-term targets, a split that favors fixed income is more advisable. If you need assistance in helping manage your investments, and you live in the province of Alberta, I'd be more than happy to sit down with you and review your investments with you. If you're outside the province of Alberta, I'd recommend you sit down with a licensed financial advisor to make sure that they know what your goals are and that you're on the right track to meeting those goals. Now that we've discussed what to do during times of volatility, let's explore the other side and what to avoid. First thing, we don't want to panic sell. If you're selling in a down market, it's possible you could be locking in losses. Just because your portfolio is in the red doesn't actually mean you've lost money. It's only lost if you close your positions in the red. If you're tempted to sell at a loss, revert to step 1 and 2 in the prior section. Second, refrain from finding hot stock tips or trends. It's impossible to predict where a stock may move in a given day, week, or even month. If you're investing based on a hunch or gut feeling, it's not a good strategy long term. Before you invest in any stocks, ETFs, or other assets, do your research and invest only in quality investments. Don't ever gamble with your money. If you need help with this, speak to your financial advisor. Thirdly, don't ignore your portfolio completely. It's good to review your portfolio every 6 months to a year, either on your own or with a professional to make sure you're on the right track. Don't track it every day because that's going to stress you out. Monitor it, check your statements when they come in, and adjust as needed. Finally, don't have any knee-jerk reactions to short-term news. Yes, it can cause the markets to fluctuate greatly in a matter of weeks, but remember that you're not in it for the short term. Over the course of decades, your investments should go up, as observed in the decades leading up to today. While returns cannot be guaranteed, we can reasonably anticipate that your portfolio will go up within a certain range of potential returns per year. And remember, time in the market outperforms timing the market. In uncertain times, it's normal to panic. While you may be inclined to follow the panic and noise, I challenge you to stand out from the noise and remain grounded in your goals and pursuits. You are an investor, and you know that investing means risk and possible reward. Instead of stressing out and trying to get out of a downward market, view it as an opportunity to buy your favorite stocks and mutual funds on a discount. So take advantage of the downturns and bolster your portfolio if you can. If you found this video helpful, be sure to like it and subscribe to the channel. Thanks for watching, and I'll see you in the next one.